Okay, now what are we seeing? Are we seeing
We're seeing your bar and the presentation, but just the bar as well.
okay, so I'm just gonna go to slideshow. Let's see if this
Perfect.
does it. Are we now
Yeah,
seeing a
looking good.
slideshow? All right,
Yes, looking good.
better than expected. All right, everybody, welcome. We're gonna talk numbers, and I hope I hope we keep you awake. I hope you walk away with more confidence on numbers than you had coming in today. I hope you learn a few things. I'm going to tell you, I have a lot of information. You are not expected to know it all. We're not going to do any pop quizzes or anything like that. And you're going to have the slides, which are going to be a reference for you. So I feel like what I'm doing is taking you through things that are going to be, just verbal, but then you'll have the written to be able to reference, which will be helpful. So, and without further ado, I'm going to jump right in it here. Here's what we're going to go through, but I'll just, instead of telling you what I'm going to tell you, I'm just going to tell you it. So for those that don't know me, my name is Susan Richards. I'm co-founder and managing partner of numbercrunch. We do FinOps for tech companies. So that's essentially CFO, controller, bookkeeper. We are headquartered in Ottawa. We have clients all over Canada, and we're looking for, working with people who want to grow their business. So that's where my background's from, accounting and entrepreneurship. So I have a business. I've had a few businesses, so I feel you in where you are. And I'm also an accountant. So those are the two aspects of my personality. Most of us that start a business have multiple sides to our personality. So these are the two. And luckily they come together for programs like this. So I'm going to my goal is to share financial information that's relevant to you, the business founder. The format, this is a sprint. So I'm going to sprint and then we're going to pause for questions and sprint and pause for questions, repeat until we get through a lot of slides. And we'll see how it goes. Maybe we'll get through them all. Maybe we don't. If we stop and we have deep, meaningful conversations and don't get through all the slides, that's a win. If we get through it all, that's a win. We certainly want to have some interaction because I think the true value is when we talk about your real life experiences and answer your questions. No question is silly or wrong or stupid. So, and just remember, if you have a question, the answer will be helpful to others too. So I encourage you to raise a hand or whatever at any time. I'm going to go into pricing variables first, because that's a key component of financial, obviously it dictates how revenue is brought into your business. And the format I'm using here is essentially taking you through a lot of questions to consider. You may not have answers to these today, but these, I really encourage you to think about all of them at different points from a daydreaming standpoint to ensure that you've thought of them. Starting with, how is your business going to make money? That's essentially what we're asking the question for. Like, how do you make money? Often we create something because it has a great solution. It's going to create an impact, but ultimately, how is it going to make money? And how much money does it need to generate? Now, this is a group of women who are extremely ambitious. You're building businesses to attract investment. So you cannot think too huge. Whatever you're thinking, bolder. So that is a key thing to keep in mind, that I'm not assuming that this is a lifestyle business you're creating, although we want to have a fabulous lifestyle. I'm assuming you are creating a business that has a big trajectory. And what that means is an investor actually could get a 10x return from your business. So what you're creating is something that if an investor gave you money in 5 to 7 years, you're thinking in terms of how do I give them 10 times their money back? And here I'm highlighting, do all investors get a 10x return? No, they don't. But the reason that we talk in terms of 10x is because there are, some that don't pay off at all, some that pay off a little bit, some that pay a little better. And overall, an investor is looking for a decent return. And in order for them to realize a decent return, all the opportunities that they're investing in have to be large, have to have large potential. So just want to encourage you right out of the gate to be bold. And if you wonder what that bold looks like, here's another thing to consider. So this is T2D3. It's essentially how a business can get to 100 million in revenue in rapid succession. And mathematically, what we're talking about is reaching $1 to $2 million in annual revenue. And then from there, tripling it, doubling, and doubling. So if you hit 2 million, triple that to 6 million, triple that to 18, then double to 36, 72, and within 6 years, you're at 100 million in revenue. Big numbers. And so keep that in mind when you're thinking about creating a financial projection, a 5-year plan, how big you want that revenue to go. And then so first of all, I'll stop right there. Any questions about setting the stage for big? And even if you don't have revenue today, or you have very little revenue today, everybody starts somewhere. Even a $100 billion company one day had no revenue. Okay. All right. We're going to go now into variables. So now that we know that we want big money coming into the company from clients, we want to think of who are those clients? Who did you build your product for? And what is the solution that they're willing to pay for today? I need to get your faces off my slides. There we go. Your beautiful faces. I do like seeing them, but they're blocking my view. Okay, so a couple of things to keep in mind with that question are we're building for the future. So our vision is usually a product or a solution or a service that maybe we haven't yet perfected yet. It's not quite there, but we may have MVP of it. We might have something that we can sell today. So keep in mind both what you've got on the shelf today that you can sell, or what you've got from a service capacity that you can sell today, and what you're going to design to sell for the future. Both of those are relevant to get the money flowing in. What's the value that your client's actually going to get from your offering? Keeping that in mind will help you understand where their buyer behavior will be. And what metrics can it be priced on? So like if you are selling something to a customer, how can you sell it in such a way that they'll say, yeah, I'll take 7 of those. So thinking of that unit that you're selling and how that can become scalable. And we sell 1, we sell 7, we sell groups of 100. Is it a per seat, a per user? Is it functionality? All those different kinds of things. And thinking about how much they're going to pay and the structure of what they're going to pay. Are they paying you a recurring stream of revenue for what you're offering? Or is it one time? Or do you have recurring and one time? Get as much as you can. Some businesses, you have the opportunity to have a recurring stream, but you can almost always these days add on a one-time fee at the beginning that can help cover some costs. What will your invoicing cadence be? So if you are creating, for instance, a product, a software product that you're selling, is your client going to pay monthly through a credit card? Are you able to invoice them annually for a license that lasts the whole year? Thinking through that cadence. Is it going to be quarterly? Maybe you can invoice 2 years up front. Maybe you can invoice 3 years up front. If you have a product and you're shipping it, maybe you can sell 50 units up front and they pay. And in other businesses, sometimes in service-based businesses, you actually have to render the service before you're going to be able to invoice the client. So thinking through that cadence is important in your model. And does your pricing model produce increased revenue? So in general, when you're thinking through your whether it's, again, if it's a product that has a subscription, thinking ahead to how that subscription fee could be increased. So it's not necessarily an all-in solution. It's something where you have a set number of features, but what is the way that your customer can pay more? Is it, if it's a product, is there a small, medium, and large? Is there a 5-unit, 10-unit, and 50-unit, that sort of thing, building in that ability to scale. And then thinking through how many they'll buy. So from, so thinking about the amount that they'll buy, how many users are there? Are there increased features? And what's your expectation of your customer over time? So if you really get into the daydreaming, that's the important part of this. Thinking through your current customers, your ideal, your dream customers, what are the ways that the elements that they value, and what are the things that you can sell more of? So if you're selling something to an enterprise and they get access to everything right out of the gate, then you may have a difficult time increasing your pricing. But if what you're selling them is one seat, one access to one set of features for a set period of time, then you may have an ability to increase the amount that they're buying over time when they love your product. And then thinking through how long they're going to stay. How long is your customer going to be a customer? So if you think about Starbucks, we go in and we buy I think $7 latte these days. That's a one-time purchase. Well, how long have you been a Starbucks customer? If you're a customer over 10 years, how much revenue is the lifetime of that customer relationship? So keep in mind with your solution, is your lifetime, is it a one-time sale? Is it an ongoing, you want the relationship to be a 5-year relationship where they continue to engage with you and use your solution for that amount of time? That is a real key component to building out your financial model. And thinking through procurement process. So if you're selling, this is really important if you're selling to enterprise or if you intend to sell to enterprise. So let's say it's a large company and you have a solution for them. Thinking through who are those players in the process? What are the various steps that will lead to sign off? How do they actually pay their vendors? So for example, a pro tip for customers that if you're building a product that you think people can pay by credit card today, if you're selling into an enterprise, it's actually pretty tricky for them to get a credit card situation happening, especially at a large dollar volume. You are going to have greater success packaging that into a one-time annual license fee that they sign off as if they're buying a product.
Susan?
Yes.
Hi, we have a question from Sophia.
Awesome.
She's got her hand up.
Hi, Susan. Yeah, just a question about the lifetime value.
Yes.
So we have some data from customers that buy our product through our website, but it's always been unclear to me, like, how do I identify what that lifetime value is? Is it, yeah, if you can just comment on that a bit more.
Absolutely. So I'll cover it a little bit now, and then I'm going to cover it again when I go through the metrics. But I like repetition, so I like the opportunity to say it now too, because that increases the chance of retention. And so speaking of retention, the lifetime of a customer is actually mathematically, it is calculated by taking 1 divided by the monthly churn percentage. And so because let's say you've been in business 2 years, you don't even know if a customer is going to stay 5. You don't have evidence to show that. But if you're recording your monthly recurring revenue every month by customer, and then it really, a couple of things depend on if it's an annual subscription or not. How does your business work? How long?
Yeah. So we're a pet food company, so that's where it becomes complicated, because we've noticed there is some cadence in terms of how often customers will purchase, but it's not monthly, and it depends really on how large their previous order was, right? Like how long do the treats last in their household. So we've seen a bit of that trend, but yeah, we don't have something that is like, like monthly we get like the same customers will offer buy monthly. We do have some subscriptions just to add to that, but it's not the bulk of our revenue right now.
Okay. So, if it was subscription, then essentially you're tracking your MRR by customer and in aggregate. And then as MRR drops off for that customer, that results in a churn. So it would be the amount of MRR lost by the starting MRR, that percentage becomes your churn, and you calculate that each month for your customer base. And then from that, so let's say that was 1%. Let's say you had $100 in revenue and one customer at $1 dropped off. That's a 1% churn. 1% churn is, you see, take 1 divided by 1% equals 100 months. So the math for your lifetime is 100 months in that example. In the event that it is not consistently month over month, but there is a bit of a pattern, then I would cast that net wider. So I would probably calculate it on a quarterly basis and see what the trend is quarterly. But I can work with you one-on-one to try to get to the metrics on that. So if anybody
thank you.
trying to figure out how to apply metrics to their business, happy to try to figure that out for you.
Perfect, thanks.
No problem. Okay, any other questions at this point? Okay, I'll keep going with respect to the procurement. And so keeping in mind, like if your customer is going, well, the more that you can get them to pay up front, the better. And in 2023, a lot of times you can get companies to pay for their products, their solutions, certainly their software annually in advance. Money in sooner is obviously a good thing. It can help fund your business. And will they want, let me see, I got bars in my way again. Can't see my slides. Oh yeah, whether you're going to have to give a contract or not. So a lot of times if it's a technology product, or if it's a physical product, you're shipping the product. But sometimes in an enterprise solution, you may need to work through a contract, and your client, if it's a big enough client, they may be dictating what that contract looks like. So just keeping in mind, the key thing around all this is building in the necessary time for this procurement process to actually happen. So if you think, well, we're going to start selling next year to large enterprises, and you immediately start thinking you're going to sell, right away and within 30 days, it's likely to take 6 months or more, depending on these different factors. So just make sure that you know them as soon as you can. Another thing to keep in mind in your price when it comes to affordability is whether you have to pay for customer service. And you can charge extra for this as well. So if you think about a car, you buy a car and you still have a service warranty. You can buy software and there could be support that a customer pays for. So keep in mind, does my solution, does the customer need 24/7 access? Do we need to be monitoring anything to ensure that the solution is always working? Do I actually need to engage with the customer to make sure that they're always mindful of the solution? And is there any compliant, if your technology, is there anything from a compliance standpoint that I need to bake into this product? And I need, especially as I scale. So keep those things in mind, because when we launch a business, often we're only thinking about the costs we have today. We're not thinking through these scalable type costs that come up. I see a comment. Is there a question? Katie, you'll let me know. Found that you don't need to accept the clients. Thank you, Sar. Is it Sarge? Am I saying that correctly? So she says, I have found that you don't need to accept the client's contract as is. They will modify regardless of how big they are. It depends. It depends. And sometimes you can get away with your own contract, but you certainly should be prepared for the fact that there's going to be back and forth, and it may take some time. But it never hurts to try to negotiate, that's for sure. Okay, so once you're generating revenue from your customers, when are they going to pay you more? So keeping that in mind, again, the more that you can think this through early on, the better off you'll be down the road. So is it more users? Is it unlocking features? Is it multi-channel? Is it renewal? That's for like a tech software product. Others might be small, medium, large. If you're building a product that has features in it, you may want to turn off some features before you ship it. in order to increase a price point. There's different things that you can do to make sure that you have like a version of a small, medium, and large. Okay, I'm going to stop right there on those pricing variables. Questions? Have you got your pricing all figured out already? Mastered? And if not, what are the things that you think you might want to add in next?
I have
Anybody?
a quick question,
Yes.
which maybe depends on what you're selling, but I'm thinking of like increases of rent. Is there, when you're increasing your price, is there like a percentage that you should stick? Like, you don't want to double it. And does it just depend on the features or the additions that you make on how you can justify the increase of cost? Or is there like a rule of thumb on it's good to increase per this amount per year?
Excellent question. So really, different business models, I'd say, have different approaches. So in a service-based business, you would generally want so let's say you're billing for labor, you would generally want the revenue to be twice as much as your cost. You're going to have a gross margin equal to 50%, and that will generally give you money to cover your rents, your general overhead, and some money towards sales and marketing. If you're building a product company, then you're going to be shooting for a much higher gross margin. So your costs associated with that would be hosting, maybe merchant processor fees. So you're going to have an 80% gross margin. And then you're going to allocate your operational funds more like generally 35% towards R&D, 35% towards sales and marketing, 20% towards G&A. So your rent would fall in the G&A. And I would say as a whole, you want your G&A category of spend, which would include insurance, bookkeeping, office supplies, all that to be within 20%. So it does require, you don't only want to think of the cost of the unit of the item you're selling. It's a question of how much excess you should have in that price, depending on what it is you're selling. Generally speaking, if your rent increases, you would not be increasing your pricing. So there's variable and fixed expenses. Variable expenses are ones that would generally fluctuate with your revenue. So as you have more revenue, you tend to incur more cost. And there are costs that are considered more fixed. Now, rent is generally more fixed. Having said that, in a scaling organization, it would be tied to your head count, which you would expect to see grow as your revenues grow, but not necessarily in correlation, and certainly not post-COVID when we have hybrid working situations as well. Does that answer your question, Karen?
Yes, thank you.
Okay, no problem. Sylvia, I see your hands up.
So I have a question. It's related to the rule of 40. And as you are going for funding and you get that influx of money and then you're investing and trying to keep all the numbers in balance towards surpassing, keeping in mind the rule of 40, what would be that, I guess, best way, and it's what's my question, what is the best way to stay on top of that? Because there is obviously going to be strategically, you're investing, you're growing, but how do you balance the two?
Okay, so what Sylvia is referring to in the rule of 40, it's essentially you want to have 40% growth in your business. And if you don't, and that would be measured in forms of year-over-year revenue. But if you don't, you can offset that with profit. So for organizations that are not necessarily growing at the top line accelerated rate, if they were growing if their profitability was 20% and their annual revenue was 20%, then that would equal the rule of 40. So it was essentially a way to kind of step back from the almighty growth at all costs. We were in an era of having to grow. And then other forms of money came in that said, well, you don't have to be growing that much as long as you have profitability. The challenge with the rule of 40 is that you need profitability. Profitability is top of mind, but for startups, typically it's going to take, you're going to need to be at least at 1 or 2 million in revenue before you're going to be able to get to EBITDA positive or profitability. And then from there, you'd be looking to balance your growth. And, typically what happens is the money comes in, it's deployed on resources. It's usually people. And so the labor cost comes first. So your profitability drops again before your revenues increase. So you're always going to be playing with those dials. That's what that means. I would say I would focus more on, I would say sales efficiency has trumped the rule of 40 in 2023. And what we're talking about there is deploying your sales and marketing spend. So if you get $1 million that you're putting on sales and marketing spend, you want to be generating $1 million, ideally $1 million in annual revenue from that. And if you're doing that, that's a more powerful metric, I would say, in 2023 than the rule of 20. And so I would even, take the rule of 20 out of anything that you have in your deck, unless it's working for you.
I feel like this isn't even on Friday when I had my practice pitch. It came up again. I've been hearing a lot about it. So just more, what is that expectation from, still earlier stage companies, because the investors, I mean, that's their language. That's what they're going to be looking at. So how to maybe present it and explain it.
Yeah.
How your business model applies, and so they will understand where you're coming from, and it still ties in.
Absolutely. I'm happy to look at your numbers too and see which ones I would highlight and see, how we could speak to the rule of 40 in your business, or equip you with a response when people ask. What's interesting is that investors do ask questions and they don't always have the same view to what the metric is. I've seen that a number of times where and they're asking questions about a metric, and as it turns out, they've got the metric all wrong. So rather than telling them that it's wrong, I say, well, how do you define it? That's a tip I give everybody. If somebody asks you to show a metrics, can you show how a rule of 40 applies to your business? It is absolutely fair game to say to them, everybody has a different interpretation of the metrics. Can you explain to me how you calculate it so I ensure that I'm providing it to you in the way that you're looking? That is fair game. You're not going to look like, oh, I don't know how to calculate it. It's fair to say a lot of people look at the metrics differently. So I hope that helps a little bit. But
yeah, thank you.
Okay. Any other questions? Okay, I'm going to continue on.
Sorry, Susan, I wanted to clarify what you mentioned in terms of marketing and sales spend. So what you're saying is if we invest $1 million in a year, then we're supposed to get like 100% out of that investment, like $2 million in sales.
And so it's sales efficiency, and it's a bit of a spectrum. So some investors are happy if you're at a 0.5 ratio between the amount that was spent and the revenue that was created in the period. Generally speaking, this is a quarterly metric. So it's the amount spent in the quarter and then the amount of revenue that you brought in. But the revenue can be for a full year. So it's ARR, essentially. If you're a software company, then it's, let's say you spend $150,000 in the quarter and you generated $1 million in annualized revenue. So you didn't realize all that revenue yet, but you closed deals that are worth that amount. The ratio is the numbers compared. And so starting at 0.5, they tend to be of interest, but what you're trying to build, you're aspiring to at least be a 1-to-1. And then the idea is, so if you spent $1 million and you took in $1 million, that doesn't sound like you're winning. But the idea is that once you bring in that million, you've now acquired that business. And next year that you're going to you see another $1 million from that customer or close to it, or maybe even more than that. So you've covered the cost of the investment. And that's telling an investor, you give me the money, I can, essentially turn it around in a year and then create worth from it.
Okay, I got it. Yeah, so it's a 1-to-1 essentially, and it's just like return on investment. There is no return, but at least you covered it.
That's exactly it.
Okay.
That's exactly it.
Thank you.
Okay. Okay. And so, yeah, just to soothe everybody's, thoughts around it, pricing is never done. It's always an ongoing process. There'll always be somebody new hitting the market that it makes your customer want to buy from you in a different way, because from comparative purposes. So don't sweat it if you don't have it right. Like I would say, it's one of those things people are always feeling a little antsy, like, I don't know, our pricing model could improve. That you'll always feel that way. The other thing to keep in mind is you don't have, like, some of the reasons that we don't change our pricing model or evolve it is that we're worried about what it'll do to our existing clients. You don't necessarily have to change the pricing model for existing clients. Your early clients, they are champions. They are there using your product. They're helping you inform what your solution looks like. So it is fine to have different cohorts paying different amounts. And I see that all the time as well. But always continue to explore it. And so here's 3 different strategies to keep in mind. So competitor-based pricing, sometimes you just launch and you're like, well, what's everybody else doing? And my product's better than theirs, so I'm going to charge more. Or my product's a little earlier than theirs, so I'm going to charge less. So it can be competitor-based pricing. It can be penetration. So if you can come in at a low price point, you may be able to grab a bunch of market share. That is, it is a strategy that can be helpful for a period of time, keeping in mind that once your product returns to normal, you may have churn. So if you think about the Groupon days back when you'd get to heavily subsidized spa service, did anybody return to those spas? I don't know. But that is a strategy that can be used for launching and in different seasons where you want to acquire a number of customers. And then there's cost plus pricing. And this would be trickier for a software product to know your cost, because essentially you've just spent $1 million building it out. How do you know what your unit cost is of that? And this ignores competition, and it ignores how customers feel. But it can be useful if you are creating a product that doesn't exist, and you're just looking to have a basis for what am I going to charge in order to have enough money to come in to cover all my costs. So those are 3 different considerations. And if you're going to do the cost plus, and there's different costs that you want to keep in mind. So not only the cost of manufacturing or servicing or what have you, your solution, but also the costs that are associated with selling and marketing that product. Those in a cost plus situation, you do want to have a concept. If you're early stage, you want to at least have a sense of what it might cost to acquire those customers. If you're manufacturing, you also want to have your overhead and distribution costs factored into that cost. My basic tip here is, well, obviously your prices should cover your costs for profitability. But you know what? It's amazing how that can be an oversight at the beginning, because people will often think of just the unit of what they're selling, and they know there's profit in there, and they just say, well, that will cover the rest of my costs. Yishal, am I saying your name right?
Yes, it's Ishal.
Ishal.
So I have a quick question with regards to cost-based pricing. So for us, we manufacture the headset that reads brainwave activity for diagnostic purposes. We have taken into account the manufacturing costs, R&D costs. What I always get confused about is the CAC cost, because for us to acquire a customer in this present day, we need to go through a validation study with the hospital, which can take upwards of 6 months. So is the cost associated with the validation study going to be a part of the CAC, or is that going to be R&D?
I would say it's R&D. I think it models much more like R&D, where it is going to be a cost that it's kind of absorbed over an extended period of time by a large base of your customer. So I would budget from an R&D standpoint, and then thinking about a period of time, let's say it's $1 million. How many units am I going to sell over an extended period of time to offset those costs and factor it in that way?
Okay, perfect. Thank you.
You're welcome. And is it payout?
Yeah, hi.
Not
So,
payout.
hi. So my question about customer acquisition costs is, so we sell GPS tracking solution, which comprise of hardware, the tracking device, which is placed in the vehicle, and the monthly plan, which is a subscription fee.
Yep.
So it could make, and we sell to a combination of small business and consumers.
Okay.
So when we sell to consumer, we sell online, let's say through Amazon. My question is, for customer acquisition costs, should we factor in the ad spend promotions that we did? And also we introduced penetrative pricing initially. So also the discount that we gave on our standard price as acquisition cost, or just the ad spend and whatever it took to get the customer?
Excellent questions. Okay, so a couple of things here. In general, customer acquisition costs is broad. So I would group everything, all your sales and marketing costs, and that includes the labor as well as the ad spend, as well as trade shows, banners, all the different things that you spend money on that are for the purposes of adding customers. That goes into sales and marketing category. And then you divide that by the number of customers you add in the period. So, and in your situation, when you have two groups of customers, I would start treating them all as customers. So for the sake of CAC, it would get blended over everything. So if you added 5 of this kind of customer and 5 of that customer, it's just a total of sales and marketing spend divided by 10 customers. Yeah. And then as the discount, so on the revenue side of things, you're going to have your subscription. So that's going to be MRR, monthly recurring revenue. Then you're going to have your product. So that's, you'll want to have that highlighted on its own line item or product revenue. You're going to have your costs of that product. So it's going to have its own margin. And then you're going to have potentially non-recurring revenue. So you might even have a setup of that product, or maybe you want a warranty or something like that. So there could be another revenue line. And then I would add a discount line. And you can get away generally with not including your discount in sales and marketing costs. It just sits as a negative revenue. It's important to watch over time, because you'll be able to see how, discounts should be used strategically and generally not ongoing. But it wouldn't go into your CAC calculation. Okay. It would be highlighted as either a cost of goods sold or a negative line item on your revenue. So your total revenue would be your subscription revenue, your product revenue minus your discounts.
Understand. This really helps. Thank you.
Great. Any other questions? Okay. And so another thing I'll highlight is we just talked a lot about cost plus. If you can also, consider value-based pricing. So this can be tricky, depends on the situation, but if thinking about what the value is to the customer. So if you're creating a solution that allows the business that you're selling to automate something and not incur a person, so you're replacing a person, for example, then the value is the savings between the salary they were paying and your solution. So you may, instead of charging $9.99, you may actually be able to charge, $50, because it's a considerable savings. If you can think through what the value is, and value comes in the form of time savings or dollar savings to your clients, then wrapping your pricing around that value can tend to be more profitable. It really, again, it depends on the situation, but it's worth considering if that wasn't a pricing strategy you had in mind. And so on the SaaS side of things, and this can work in others too, but it's pretty straightforward for SaaS. I've put here 5 different pricing strategies to keep in mind. So one, and these basically are usage pricing. So as the usage volume goes up, the pricing goes up, maybe the price they pay for volume. So that would be an example of our phone packages when we have data and you get data tiers and that sort of thing. So the amount of data usage. Other products, it could be the amount of times they're logged in, active, could be, if it was a product, maybe that product's disposable and maybe it's good for 5 uses. There could be different things there on the usage pricing. User-based pricing is literally the number of users. So you may have the same solution, but customers only legally allowed to have 1 person sign in. And so they pay a price per user and they can increase the amount of users that they pay for. Tiered pricing is essentially, you might have groups of features done in different ways so that you can have a starter program where you get access to a little bit of the value, and even in a hardware product, you can turn on factors and turn off factors to try to help with this sort of thing. So having different tiers based on the customer, and that's usually thinking through the persona of the customer. This is a customer who uses my product in this industry. This is the feature set that they need. This one over here, they need a lot more. So tiered pricing is another one to consider. Flat rate pricing it's the same no matter who you are. I think Netflix is pretty much flat rate these days. I think we all are basically paying the same amount. Maybe not, actually, maybe that's not a good example. I'm not sure. I never asked my friends how much they pay for it, but we all know what we're talking about there, where you pretty much always charge the same. And then there can be a per feature pricing, which is, turning on different features. And we all know that experience in software where you're trying to do something like, oh, I need to upgrade my Zoom account. I get 45 minutes. Nope, now I need to go into the pro and then I get access to this. And then you level up again and you get access to different features. So all of these are pricing strategies to consider. Your goal is to drive up your price. Not that we ever want to have to keep selling to our customers, but you want, as you scale the business, you just want a nice, simple, understandable plan for your salespeople to be able to sell, or for customers to be able to order online. So, and the goal from an investment standpoint, again, we're trying to get, that 10x revenue. So the way to get that is by building in these systematic pricing increases as your customer gets more value from your product over time. Any questions? Do we need Katie, are we at the point where we do a break, or are we too soon for a break? Where are we?
I think a break is good.
Yeah.
I had
Everyone.
just before
yeah.
we go for a break, I'm going to put sort of my Julia hat on here, Susan, and really just from an investor perspective, not so much how important is pricing, but to what level of detail should you go into with your pricing? How much do they care, I guess. And I suppose every investor is different, right? In terms of how deep in the weeds they want to go on pricing.
It's such a great question. So I would say that you don't need to have complexity in your pricing in your investor conversation, but I would say that it's the opportunity to really jazz them up and inspire them, because if you have thought through this, then there's usually a good story, like in the detail of explaining how your customer is going to start with the basic, and then they're going to add this, and then they're going to add that, or you're going to sell your product into one department in a hospital, and then through their use with their patients, it's going to cascade through, and you're going to have these bulk offers. If you've thought that through, you're going to be explaining that with a great amount of confidence, and it's easily understood. Investors are hearing a lot of pitches, and it's pretty easy for them to kind of be detached. But the more that you're able to talk about these details, the more they wrap their head around it and get jazzed. Oh, it's a good point. Networking effect or viral effect, or it's logical. Yeah, everybody's going to want more. So I'd say that's the importance at this stage of of thinking through the pricing.
Right.
Uh,
And I guess it's showing how strategic you are in thinking through it, like you were just saying. Right. So it's not a
Exactly.
separate thing, like it's all tied and integrated with your business strategy.
So true. So true. Yeah, it's a good way to demonstrate strategy.
Right.
Even if it's not anywhere else and it's not happening yet, like what you're selling is basic. You're selling, when you're selling to investors, you're selling the dream. You're telling this is where we're going. Like, come with me, we're going there, and look at, so that's where I'd say the relative importance is at this stage. And then down the road, it will be the piece that generates revenue without effort. So as you need less and less sales and marketing effort to increase your revenue from customers.
Right. Thanks.
You're welcome. Any other questions before we take a 5-minute stretch break? Okay.
Okay, great. I'll start the timer. I won't let it go off, but I'll start calling you all back after 5 minutes.
Awesome.
Okay. Welcome back, everybody.
Wakey, wakey.
Wakey wakey. On a related note, if anybody is hungry or needs a snack, needs to fuel up during these sessions, please don't hesitate to eat. We don't want to stop you from that. That's for sure. Nobody needs to be hangry. Yeah.
That's right. Yep, be comfortable, feel free to eat. If you need to stretch, if you have a treadmill. I remember one time we had a meeting, Katie was on her treadmill for it, which I endorse entirely.
Yeah, I had to. That was COVID time, desperate times, needing to do something active and yeah, trying to get on the treadmill as often as I could muster up the energy. Okay, I'll hand the mic back to you, Susan.
Okay, great. We've got everybody back. Tutu ready to go? Okay, looks pretty much, we got a good showing. All right, I'm gonna keep going then. We're gonna talk metrics. Ooh, maybe my favorite topic. So which ones are key? Here they all are. So EBITDA, path to profitability, runway, sales efficiency, revenue growth rate, month over month, revenue growth rate year over year, NDR, NRR, that's net dollar retention, otherwise known as net revenue retention, both the same one, churn rate, logo retention, LTV to CAC, that's lifetime value, cost of acquiring a customer, payback period, and cash burn rate. These are the biggies. Okay, so let me go into, let's see, I see comments here. Oh, it's true, Katie. I do love metrics. I really geek out on it. So if you're stumped, you don't be shy. Ping me and I'll look at it. We'll try to map out your metrics if you don't know how to calculate them. First thing I'm going to talk about is earnings. Earnings before interest, taxes, depreciation, and amortization. EBITDA. Some people say EBITDA. It's okay. Say whatever you want to say. It is essentially indicates if your business is profitable. It's not net income because net income has interest and taxes included in it. But it is essentially, this is like the bank's form of profitability. And 5 years ago, maybe 10 years ago, a technology SaaS company was not ever expected to be EBITDA positive. You were expected to just grow, deploy cash and buy customers and let your revenue grow. And that was really all anybody was interested in because there was always ways to make money along that journey. But it is a new world and EBITDA has been hot for a past 3-4 years. And now you will find it everywhere. So EBITDA is if your expenses are higher than your revenues, you are not EBITDA positive, and every startup begins not EBITDA positive. So if you are not EBITDA positive, you are in good company. But you do want to have in your projections a plan to eventually reach EBITDA positive. So I've said EBITDA positive a lot. I'll move on. Revenue growth. Okay, here's a bunch of them. You want to know like what you need to be. So in general, month over month revenue growth is 10%. You want to show that your revenues are growing by 10% every month on average. Sometimes it's spiky at the beginning, but that's a decent growth number that people look for. Another way to look at is annual growth rate. So showing that you're growing your revenues 30 to 40% per year. Now, keeping in mind when you're starting, if you have a really small revenue base, percentage-wise, it's a larger percentage usually year over year. As you scale, it's harder to maintain those percentages. But these are the kinds of numbers that people will often throw around and investors are looking for. A net revenue rate that you're going to look for is certainly greater than 100%, ideally greater than 110%. Top SaaS companies, it's 130, 140%. And I'll explain what that is in a minute. Gross revenue rate is greater than 90. The most it can be is 100%. Again, I'll talk about that in a minute. And sales efficiency, we went through that earlier. We were talking about that's where you spend the money and then how much annual revenue do you generate from it. So 50% to 100% or 0.5 to 1 is where we're looking for there. I can't see if I've got anything lower than that. Is that the last one on this slide? That is the last one. Okay. So let's talk gross revenue retention and net revenue retention. So we're going to talk about the bottom one first, because this is the one, I should have it probably at the top, but arguably the most important one. And so what you're doing for this calculation, you're looking at your revenue from your customers 1 year ago, and now you're measuring the amount of revenue that you are getting today from those same customers, and only those same customers. So you don't include any new customers you've added throughout the year. You're only looking at the cohort from a year ago. And if your revenue now is, let's say, 20% higher than it was 1 year ago from those customers, that would be 120%. So it was 100% of your customers plus the 20. If that's your net dollar retention of 120. And that would be telling somebody that even if you didn't spend any money on sales and marketing to acquire new customers, your revenue is growing by 20%. That's why investors love this number, because it shows that you don't have to spend any more money in order to grow revenue. So should you run into a cash flow issue and you have to stop all your sales and marketing spend, you're still going to grow your revenues. So this is what you're trying to get to. And this is why that whole pricing activity that I talked about in the first section is so important, because you want to be able to create a scenario where your customers over time are giving you more money than they used to give you. Okay. Now, gross revenue retention doesn't allow you to take any revenue expansion. So it is a measure purely on your ability to retain customers and retain customers over a period of time. So again, you start with how much revenue you were making from your customers a year ago. And now you are of that revenue, how much is still with you. So if you've had churn or if you've had pricing decreases, you have to include that in the calculation, but you don't get to include any new customers, nor do you get to include any revenue that's higher than the price they were paying 1 year ago. So the most this metric can ever be is 100%. That would indicate every customer that you had a year ago is paying you at or more the same price. You didn't lose any customers, and they didn't downgrade pricing. So a good gross revenue retention rate is 90%, and a good net dollar retention is greater than 100%. Okay, any questions on that one? This is a really important one to know. It's actually not that easy or not that complicated. It's to know intellectually, right? The way that you would calculate it is if you're tracking. So if you're tracking, you want to track revenue by customer every month. That's going to give you the base of information inside of an Excel workbook to be able to measure this pretty simply. It's not complicated math. If you're not tracking your revenue by customer, then it's a lot trickier. You can't do it in aggregate. So you can't say, well, my total revenue last year was this, and my total revenue this year. You're not going to be able to get it from there. You really have to break it down by customer. Okay. Yes. Payal?
Yeah. It's intuitive to you and a dumb question, but I'll ask anyways.
Please do.
So, so we sell GPS tracking solutions. So the trackers, so each customer may have like one device and then one subscription corresponding to that, or
Yep.
a customer may have 20 trackers and 20 subscriptions corresponding to that.
Yes.
Depending on whether it's a business customer or consumer customer, right? So then do the ratios change?
So it's a good question. So that kind of all speaks to what is a customer? What do what do you consider a customer? What do you consider an account? What do you consider? Are you measuring by a user? Are you measuring? I generally kind of go with a logo. So sort of the largest way of defining a customer. And I would say in general, it means that your sales and effort went to land that logo. Inside that logo, they may have many subscriptions. So they may, and so the revenue that you had from that logo 1 year ago might have had 5 subscriptions, and now you have, let's say, 8 subscriptions, so you grew it. You would have a positive net dollar retention from that customer likely. If the opposite was true, let's say you had 8 subscriptions a year ago and now you have 5, chances are you've had a contraction, but you haven't had a churn. Whereas if you defined it on a subscription basis, your metrics would look very different. So of your 5 subscriptions a year ago, you would only count the 5 that you have remaining in your, let's say it went from 5 to 8. Well, 3 of those are new, so they wouldn't be in the calculation at all. And if you went from 8 to 5, you've incurred churn now. And so the key thing with all of the metrics is defining what your unit is. And generally I go with a logo. And if you were an enterprise, if it's an enterprise, it might be a master service agreement that you have. And then you might have many contracts under that, but one master service agreement. So using an example, I had a client, and you'll have all different sizes. So I had a client that had a technology product that sold into restaurants, and they had individual restaurant owners who might have 1 restaurant, they might have 2 or 3 restaurants, but they were small. And then they had A&W Canada that had 700 restaurants. That was still one logo. So the revenue per customer was a huge swing, but because we defined it by logo, each of those was just one unit. And the key thing is you have to be consistent. You wouldn't calculate your churn one way and your NDR another way and your growth rate another way. You do want to define that unit, and it may change over time. So at some point it may make sense to change, but usually starting out, I go with logo.
So do you think that we should have have different method based on segment? Like for a small business, who small and medium that we target, I think logo would work. But for a consumer, then it is probably not ideal.
Yeah, so eventually you'll want to segment because you'll want to see how you're performing differently. And especially if you can separate the sales and marketing costs, often it's a bit murky because you have resources and they're working in all different, like they're working on the consumer and they're working on the enterprise. So how do you allocate their time? I would say in general, that's expensive to do when you're smaller. So I would group it all. But as you get bigger, then for internal purposes, not necessarily, so for investor purposes, I would probably keep it on the big side. But for internal purposes, when you're making business decisions as you get larger, then you may want to make sure you're separating those costs so you're able to analyze them. But I have customers that have like 10, 20 million in revenue, and we're still doing it primarily in aggregate, even though they've got big differences between them. It's just ultimately what you're trying to do is drive your business in a forward direction in aggregate. So I keep it simple for now. Everything kind of gets grouped together.
Okay, thank you.
Any other questions? Let's see, hands. Okay. Runway and paths to profitability. So runway is like, so when someone says, what's your runway? That's how many months until you're out of cash. There's a way to calculate it, and then there's a real reality. So from a calculation standpoint, you take the amount of cash you have in the bank, and then you look at your the difference between your revenues and your expenses. So what's that gap? And you do the division to see how many months you got left. So if you were burning through you've had a negative expense of or an EBITDA negative or a net loss of $100,000 a month, and you had $1 million in the bank, that would show that you had 10 months of runway. Okay. That is more of the metric of runway. From a practical sense, people generally mean what's your like, when are you truly out of cash? Because often in the startup phase, you don't have a consistent burn of 100,000. So you've got to be mindful of the future, like of your cash flow projections, and know when you're out of cash. So runway. When you're raising money, they want to see that you're going to have 18 to 24 months, generally more like 24 months these days of runway. Sophia, question.
Yes, it's on the runway and debt. So what happens with liabilities? Like if we have like a line of credit, would that we would take that into account for calculating runway?
In general, line of credit, no, but if you had a bank loan with fixed payments that you had to make, then yes, then that would be expected to be. So on the calculation of runway, it's generally not actually factored in. So it's generally calculated as your expenses offset by your revenue. So it's not even truly cash, because your revenues may not be representative of cash inflows. So from that metric standpoint, it doesn't even factor in bank loans. From a practical sense, in your business, though, if you had a loan and you were paying $10,000 a month, you would want to make sure you were factoring that into your equation of when you're going to be out of cash. Lines of credit are typically, perceived to be in perpetuity. So if you're into your line of credit by 50,000, well, you would, and let's say you had another 50,000 available, your out of cash date is probably when you've maxed out your line of credit and you're literally out of cash. So that you've used all of
the resources. Yeah, okay. Thank you.
Okay. And then the second thing you want to have awareness of is how long you're EBITDA positive. So you're doing projections. One is, when am I out of cash? And another one is, when am I going to be profitable? And both of those are important to know. Business these days, like I said, EBITDA positive is on trend. And so you really want to be creating a plan. So if you're going to take on money, let's say you're going to raise $1 million, you want to be able to understand how that money is going to be deployed and if it can get you to the point where you're profitable within a year. So you wouldn't necessarily spend all the money on, like, you'd have to consider where the money's going in order to reach that profitability. So projections are important, always having rolling forecast. Now let's get into LTV and CAC. So what are you looking for in here? You're looking your LTV to CAC to at least be 3 to 1. That basically says to an investor, if they give you $1, you're turning it into 3. That's a good return. If it was 1 to 1, well, why am I giving you $1? You're only making $1 from $1. We're not making money. So 3 to 1 is the minimum that you're looking for. And the sister or cousin metric to that is payback period. So you use a lot of the same mathematical ingredients in both of these. This payback period is saying, when you acquire a customer, so that you've incurred cost, you've taken your sales and marketing cost divided by the number of customers, you've got your CAC now, that's your cost of acquiring a customer. How long does it take for that customer to pay off that CAC? And you ideally want that to be under 12 months. And if you're in a situation where you could invoice your client upfront for 12 months of service, or like a 12-month subscription, and you have a payback period that is mathematically less than 12 months, then you're essentially funding your growth. You're able to, I spend $100,000 this month in sales and marketing costs. I invoiced my customer for $100,000 in subscriptions. When the customer pays for that, they just paid off your sales and marketing. So if you have a payback period less than 12 months, you're essentially funding your own growth. These are two things to keep in mind. And well, I'll get into the math of them. So in order to, yes.
Hi, sorry to interrupt. We actually just have a question from Payal.
Wonderful.
Sorry, I saw you move on to the next slide, so I didn't want to break your flow. Sorry, one slide prior to this.
One more.
EBITDA.
Yep.
Yes. So I had a question about categorizing revenue versus grants.
Yep.
And so we are right now, we have some market validation, so we make money,
Yep.
but we also get grants. So
Yeah.
when we calculate the EBITDA, can
Yeah.
we include the grants in our
Yes.
positive? Okay.
Yeah. Yeah. And you know what? Somebody may say to you, oh, you shouldn't include your grants in there. And they say, yeah, they're part of the operating income in our business. So yes, the answer would be include grant money in your EBITDA. It is located in other income, so it's generally not put in your revenue section. That's typically reserved for customer revenue. So you have revenues, then you have your expenses, then you have other income. You'd have your grants in there, you'd have your interest income in there. You have other expenses, that's where your depreciation and maybe interest expense and things go. And then you've got your bottom line. Okay.
Yes, but the depreciation would not be included for the EBITDA calculation, right?
Correct. Yeah, sorry. What I was describing included interest and depreciation as part of like getting to net income, but correct. You would not include your amortization, wouldn't include any interest income, or, and some companies have interest income now because you're getting 4 and 5% interest rates on checking accounts. If you don't have one of those, make sure you talk to your bank about the interest rate on your checking account. But that interest is not included in EBITDA. Yeah.
Okay, got it. Thank you.
You're welcome. Okay, so getting to, did I do lifetime value? Nope, I didn't. So calculating the lifetime. This is, so I highlighted this earlier on, where first we start with measuring MRR each month. So regardless of the business early on, you really want to track your revenue by customer. And for these metrics, you're going to have a lot of data. So it's just probably in Excel. So you're going to have your the amount of MRR you have. And then when revenue falls off, so when a customer stops using your product, they are going to be churn. We're going to, if you're early days, you may want to trail that churn to 3 months so that it smooths out, but you're essentially your lifetime is 1 divided by the monthly churn. So again, if you using the example of $1 churning, if you had a starting point of 100 and $1 churned off, that's 1%, which translates to a lifetime of 100 months. So 1 divided by 1%. So making sure that you're using the right decimal there. We can go over that for anybody who wants to calculate their churn. But that calculating your churn is essential then in determining your lifetime value. So in order to have a mathematical formula for lifetime, you need to have a method for tracking your churn. And maybe you can't do it on, maybe you don't churn customers every month. So maybe it's only every quarter, or maybe you're looking at the last 12 months and we churned 2 customers. You can take an annual churn rate and then divide it by 12 to get to a monthly churn rate. Okay. And that is a thing to keep in mind too. A churn rate is per something. So if someone says, I have a 10% churn rate, 10%, if it's annual, is a good churn rate. It's less than 1% per month. 10% on a monthly basis is a bad. It would show that you're essentially all of your customers are churning over every year. So do keep that in mind, that when you represent churn, you're saying the unit, and that you're knowing the unit. It's important to know the unit. And because if you put, let's say I have a 10% churn rate in the slide and the investor interprets it as 10% per month, they just might go, that's a crazy churn rate. So just keep that in mind. Okay, calculating the lifetime value. So we calculated the lifetime. That's how long a customer stays with you. Now the lifetime value uses the lifetime as the unit of time. You also need to know your average revenue per account, which is your total revenue divided by the number of customers you have. So that's the average revenue per account. Total revenue, total recurring revenue divided by the number of customers. Then you apply your gross margin percentage, and that's, so you have to subtract off your cloud hosting or whatever those fees are and multiply that by your lifetime. That's the math. to get to your lifetime value. So in this example, we're making $500 per customer every month. We have a gross margin of 80%. And the customer lifetime, they stick with us 20 months. So the lifetime value of that customer is $8,000. So how much are they paying on a monthly basis? $500. How much is the lifetime value of that customer? $8,000. So we're saying the amount of profit we're going to make from this customer relationship over the life of the relationship, $8,000. Is that clear to everybody? When people say lifetime value is money earned over an extended period of time. And it's in a product company where you're going to sell multiple products, it's more than the single price too. So it kind of applies to all businesses. So some business models never really thought of it before. Sophia.
Yeah, a question about the gross margin. I like, in theory, you should include all your costs, right? But like, or what costs should we include? Just the COGS?
Yeah, only your direct variable costs. So it's a gross margin. Gross margin is not, so net margin is factors in all of your expenses, and it's what's left on the bottom line. Gross margin is what's left when you exclude your direct costs. So in a situation where you're buying and selling t-shirts, your direct cost would be the price you paid for the wholesale price you paid on the t-shirt before you sold it. In a software business, the direct costs tend to be cloud hosting, like your Amazon fees, because as you have more users, that cost.
Okay.
It's often your merchant processor fees. So if you're running your business through Stripe and they're taking 3% of the revenue, then it's that cost. It could be, as you scale, you may have a customer success team that's manning the phones and they're helping your customers navigate the product, and their whole goal is to keep that customer longer. That cost would be factored in, but only do that once you hire someone who has their title is customer success, and that's what they're doing full time. Not if you have a developer who's doing off the side of their desk, I wouldn't include it.
What about shipping costs?
Shipping, it depends. So I would say if it's always, so by nature, it wouldn't be. As a startup, I would put shipping costs down in G&A. If it starts to become, and sometimes customers pay for shipping. So if the customer pays for the shipping and you're recognizing that as revenue, then it becomes your cost of that shipping would become a direct cost. So that would be the difference there. If it's shipping that you occasionally buy a shipment of widgets and then you sell them individually, I would say for as long as possible, that shipping cost just goes into G&A.
Okay, thank you.
Okay. You're welcome. Sarge.
Oh, hi. I'm just multitasking here. In calculating the gross margin, you mentioned sort of the cloud costs.
Yeah.
What about support?
So in general, I would say support is in R&D. So if it's like a technical support, if a customer doesn't know how to use a product or something broke and they're literally calling technical support, then the worker that's doing that, typically in a startup, they're also likely on the development team building the work, building the product. Is that the case for your situation? Do you have support today?
We do, and it's not somebody that builds the product. It's more of a hand holder for our client.
Yeah. Okay. So, and is that their full-time job?
Yeah.
Okay, then yes, that would be a direct cost. So that would be a line item in your cost of goods sold and would be included in your gross margin.
Okay, thank you.
You're welcome. Any other questions? Oh, Payal.
So my question is, when we spoke about shipping, shipping to customers, so yes, we charge for shipping, so we can put that as a G&A cost. But when we our products like the trackers itself is manufactured overseas.
Yep.
So we kind of bring them into the country. So our landed cost includes the shipping and customs.
Yep.
Then would that go into cost of goods sold?
Yeah, so are you manufacturing, you just buying and reselling? Like you ordering and reselling?
Yes, we are ordering and then adding our software onto it and then resell.
Okay. Okay, so what I would be doing in your case is I would be including your shipping costs as well as your inventory product costs as inventory. So first it goes to your balance sheet. It's an asset that you're buying and it's sitting on your balance sheet. And I can go through the income statement and balance sheet here today as well. And then as you sell it, you bring over the cost. So let's say you have $100 for the product and $100 for shipping. So you've spent a total of $200. And let's say you have 200 units that you're selling. It's $1 per unit. So as you sell the units, you're going to recognize $1 each time. So you're moving it from inventory over to cost of goods sold, and it would be an all-in.
I understand. So from my gross margin perspective, the shipping when products come in is factored, but the shipping when the products are going out to the customers is not factored in.
Well, because I think you had mentioned that your customer is paying for that shipping.
Yes.
Yeah, so I would include that as well. So the revenue, the customer is going to pay for product revenue. So you're going to have a product revenue line. They're going to pay for shipping. You're going to have a shipping revenue line. And so you're going to also have, you're probably going to bake your shipping from your manufacturer into the manufactured price. So that's going to be your direct cost of your product. And then you're going to have a shipping expense that just relates to the shipping that went to your customer. So they paid you $10, it cost you $8 to ship it. So you have a $2 margin there. What you will be doing is splitting up. So the gross margin here that we're talking about in the lifetime value, generally speaking in a SaaS business, we're talking about the SaaS gross margin. So your average revenue, so on the subscription side of your business, you're taking your average subscription price multiplied by the SaaS gross margin. So it wouldn't include the shipping. It only includes, let's say, cloud hosting and maybe merchant processor fees. If you had a customer support, that is what's included in there, and how long a customer stays with you. And then separately, you're calculating the margin of the product. From an investor standpoint, generally what you're saying, you want to have a margin where like, well, we're making 20% off the product, or we're covering our costs of that, because the investable piece is likely the subscription that you have.
Right.
So it's going to be like an 80% gross margin.
Yes, it actually is that.
Oh, perfect. There you go. Okay.
So subscription is 80%, product is 10%, but usually I average it out, but I can keep them
Don't
separate.
average it out. Two different things. Yeah, two different things. Because you want your gross, 80% gross margin in SaaS is right on track. If you averaged it out, you might have a 50%. And if you're telling an investor, my gross margin's 50%, they're going to be like, oh, why is it? You're benchmarked negatively. Okay.
Okay. Thank you.
Sylvia.
So quick question. So lifetime value for a SaaS organization that we currently might not have support or customer care because we've been scaling, but obviously as part of the plan and the hiring, you're going to put that responsibility. So in terms of the calculation, it's going to, that trend is going to go down because now you're going to be spending money. How well understood is it by the investor, and should we be explaining that?
I don't think you have to get into it. They should know. They definitely vary in their knowledge of it, but it would be normal to have a SaaS gross margin north of 90% when you start, because you really just have cloud, Amazon fees, merchant processor fees. You don't have any labor in there. And it would be as you scale, as you build out a department for customer success, that would start to change. And so that number will drop down to more like 80%. that will be fine. Chances are as you're going from not needing the support out of with the product that you start with to being that product evolution where you end up having a support team, chances are your revenue is also increasing during that period. So your average revenue is going up at the same time your gross margin is going down. And so that's perfectly normal.
Okay. Thank
You
you.
do want to, ideally you hover around 80%. So when you start to see that it's, sometimes I see that where it's like, oh, we hired 5 people in customer success. It's like, okay, that should require a big bulk of revenue to support that. Maybe what's going on is there's a bunch of onboarding effort that's being done by that team and training effort, in which case there could be an opportunity to charge one-time fees to the client to help offset that service cost.
Okay.
Okay. You're welcome. And so here's some pro tips about the SaaS gross margin. Let's see, what did I say here? I think I said, yeah, this is just saying all that I've said. So in here, my recommendation, is once you hit 1 million ARR, that's when you start to hit the resource costs. Don't get into allocating people. So if you have a person, they do sales, they do a little bit of customer support, or they do a little bit of dev and a little bit of customer support, I would suggest you spare that. Only put them in the cost center that their full-time job is in. If a person is doing R&D and like dev and customer support, keep them in dev for a variety of reasons. From a shred eligibility standpoint, it's just easier to calculate your shred costs if the cost is included in there and you want to get the benefit of that. If once they're doing sales and marketing, you'll want them in the sales and marketing department. So the last department that and then if they're a generalist, an administrative support person that does kind of everything, they're in the G&A department. So the last department you're going to be filling up is your cost of goods sold, or that, that cost center that feeds into your gross margin. Okay. I see businesses that they're being super honest and they put costs in there, and it's just, from a benchmarking standpoint, you're just looking, your competitors that are competing for the investment will look like they have a stronger business model than you do. So there is an aspect of this, you want to understand the benchmarks and do it the way the other companies do, so you're not disadvantaging yourself. Then we move on to CAC. I should have laid it out. Cost of acquiring a customer. That's what that stands for. And it is sales and marketing expense, all of the sales and marketing expenses divided by the new revenue paying customers. So basically, and I clarify that here because just adding new users that aren't paying you, I would say a customer is not a customer until they pay. So you may have a business that builds up users and it's free until maybe first 90 days is free. They become a customer as soon as they're paying you $1, because that's how you're going to calculate all of your metrics is based on revenue. So if you have a new customer that's not paying you anything, I would suggest they are not a customer. They are a user. Okay. Yes, Jane.
What about a beta customer?
Yeah, not a customer. So I'd say they're a user. Because here's the reason why, and I have clients all the time that want to add the betas in. The problem with them is they're going to have a high churn rate. You're just experimenting with them. And although in the short run, it'll be, oh, look, we added all these new customers, which is going to bring down your CAC. The following quarter, when half of them go away, you're going to have this high churn rate. And people are going to say, well, why did they churn? Well, they were just playing around. So I would say don't include them until they're paying you.
They're paying. Yeah.
And you may even if you're subsidizing, you may want to hold them off and like determine when are they a customer. Like early on, you do want to be adding customers. So there's optics to that, but definitely would not recommend doing it if they're not paying you anything. Linda.
Hi.
No.
So I really struggle with this one because we have two sales cycles. One is more of an acquisition that's online. And so that I feel like those data metrics are easier to manage. But the other one is more enterprise level sales where there's a longer sales cycle. And as a startup, we don't have a dedicated sales or marketing person. That is, me and my co-founder flying by the seat of our pants, trying to land these larger deals. So how do you then carve out those costs to get an accurate number for scaling and growth so you know what your metrics are?
Good question. Excellent question. So the good news is right now you wouldn't have costs because it's you doing it. Your chances are your salary is in the G&A line as an executive salary. So your sales and marketing costs are low. And that, I mean, that's fine because you're also not adding these customers right now. Down the road, when you do your projections, so into the future, when you start to hire 5 salespeople, they will, so I mean, as part of what you're doing now is nurturing those leads so that by the time you hire a fleet of salespeople, you have opportunities that are going to close sooner. So as your costs go up, your sales marketing costs go up, the amount of customers coming in will be increasing as well at that time. So it'll all be based on your projections. Mathematically, it's the same. So every month or quarter, you're calculating how much do we spend, how many customers we had. There is a timing issue in CAC, right? In any business, you do, let's say, an annual trade show in October. Well, do you close customers on the spot at that trade show? Highly unlikely. It could be 3 months, 6 months, 9 months from there. So there is a disconnect between when the spend occurs and when the customers are added, especially in enterprise, but that's just normal. So over time, you'll build up that momentum. So right now, companies have your CAC costs right now with you doing the selling may just be limited to any travel that you have to do, booth participation, it might just be hard costs, may not be labor costs. Okay.
That's really great. Thank you.
You're welcome. And so here is calculating the payback period. So once we have the CAC and we've got our average revenue per account we talked about, and we got the gross margin, now we have the ingredients to be able to calculate how long it takes to pay back the CAC. So you're essentially saying the money that I take from my customer and I'm factoring in my gross margin. So the profit I'm making from the customer, how many months of that profit? So $100, let's say in my case here, I've used $1,000 times 90%. And so I've spent $10,000 to acquire the customer. They're paying me $1,000 a month top line revenue. The gross margin's 90%. It's going to take 11 months for their monthly fee, the equivalent of the monthly fee, to pay off the CAC. Okay. So you want this one to be ideally under 12 months. It often isn't. In an institutional type sale that's enterprise, there's a good chance that it does, when you build up that team, you may have a large CAC. It may take up to 2 years to pay it off. It is what it is. But when you're designing the business, if you can think of how you can have a pricing model that works to recoup those funds, or be scrappy. The dials on this one are both your price and the cost of acquiring that customer. So you're being sporty on both ends of the calculation. Yisha?
Yes. So right now our focus is on selling to hospitals and clinics, and it's easy to calculate, not easy, but it's fairly straightforward to calculate the CAC for that. But in year 2, we plan on selling to customers as well. So that's a different product line. But in terms of CAC calculations, is it going to be 2 separate CACs, or is it going to be under one umbrella? Because we haven't accounted for added headcounts for specific marketing and sales activities. We expect them to flow organically from the hospitals, from the doctors recommending our product to the clients so that they can use it at home. So how would the calculation look like in that scenario?
Okay, so, and essentially that's going to be a channel, and it's smart to think about channels. So Often we start our business, we're selling directly, we're on the phone selling in, and then we see over time, other institutions are going to sell the products for us. And we just have to give them the playbook, or they're already motivated to sell it because it adds to what other things they're selling to. A key expense that you're going to run into is that you're going to need you're likely to need a relationship manager to nurture that channel. You may need to show up and do training seminars and show up at events where those key stakeholders are present so that you can build that relationship and nurture it. Otherwise, they're unlikely to be as motivated to sell your product. It just tends to be something that needs that nurture. So I would say you should be mindful of the fact you're probably going to have to do some level of investment, but it won't be at the same degree. You're not going to be doing your ad spend. A lot of the direct costs are going away, but you will have a nurture. And I would say, again, that I would still keep it simple until you get to the point where you have to break it down. I wouldn't. I would still go sales and marketing divided by number of customers. Now, the funny thing is, when you're looking at the customers in that case, so that channel can either be defined as one customer, or each customer is actually what the channel sells. And so it'll look one of two ways. So if you have a situation where they're selling the product, then maybe depending on how you structure it, maybe they are one customer and the customer revenue from them grows over time. So there's your net dollar retention growing over time, but they're just one customer. Alternatively, if it's their end customer that you're treating as one, probably the average revenue that they're paying you is a lot less because your channel's taking 30%. So you're probably going to have a lower ARPA on that, but you will count them as a new customer every time that comes through the channel. So you'll just want to define whether you're going to consider a channel one customer or whether each of the customer. And I think often companies will decide that based on who's supporting that end customer. Are we on the hook to support them in the channel? It's just like a reseller agreement, and that once we have the relationship, it's really between them and us. Or is it the channel it's their customer and they're taking care of it? If it's the channel and they're taking care of it, I would say they could be considered as one customer.
Perfect.
And
Thank
so
you.
in that case, your CAC, so each month you're going to have your sales and marketing. You don't have a lot of sales and marketing costs that's being dedicated to this. So that's not growing tremendously, but you're also not adding a lot of customers. But what you're going to see over time is your revenue will be increasing. So your interesting dials.
Okay.
Like, well, yeah, that's a fun one. Any other questions on this? Okay, logo retention is another one. So when so there's churn and retention, they're the opposite of each other. Churn tends to be, when people talk about churn, they're really talking generally about dollars. So it's the amount of dollar revenue that dropped from the starting base. When people talk in terms of retention, customer retention, that tends to be more numbers based. You're going to want to calculate both. So you're going to want to say, of the revenue, the dollars, how much did I retain? And of the customer count, how much did I retain? And so you generally, the metrics that you're looking for are basically the same, but they tend to be spoken of differently. So churn, 1% per month. Logo retention talks typically in terms of annual and 90% annually. Those are about the same. Now, by watching both, if they're not the same, you'll see. So for example, I got a customer that has these tier 1 accounts. They make $20,000 a month. They've also got these individual user accounts. They're making about 99. They churn all the time. So this company has a very low dollar churn, but they have a very high logo churn because these small accounts are always churning. They're the people only stick around a couple of months and then they're gone, and there's always a flow of them. So from a logo standpoint, they're churning out 30% of their customers every year. But from a dollar standpoint, it's only 10%. So both metrics tell you different things. The one that is more important to your business is the dollar one, but the logo one is still interesting to know. So if you have a business where you're churning out 30% of the logos, the question is, are we actually spending a lot of cost to support that group? Because maybe we want to cut them off, or maybe we don't want to sell to them. Maybe we want to make sure that we just have a link on our website where they can sign up without any human interaction. So it shows you different aspects of the nature of your business and where you might want to either put more resources or stop putting resources. Okay. Question period on any of that. Okay, maybe we need to stand up and stretch for a minute again.
I think so. Do we want to just stand up and stretch, or do we want to take a couple minutes?
I think we need some seventh inning stretch music.
Yeah.
Oh, okay.
Maybe some coffee break.
Yeah, a quick coffee break. I can set a timer for 2 minutes. Susan, you're the one running the show, so if you want to throw music on, you definitely can, but I'll put a timer on for a couple of minutes. Everyone can take a coffee break or bathroom break.
I'm gonna put on.
We can't quite hear it. If you're sharing music, we can't hear it.
Oh,
You
no.
gotta reshare your screen, but when you go to share your screen at the bottom corner, just click share sound too.
Okay, let's see.
Oh, now I can hear it.
You hear it now? Okay.
Yeah, a little bit. Okay,
I
I'm
don't
gonna
know
run to
why
the
it-
washroom really quick. I can hear it a little. It's just you have to share through the screen. That's all.
Okay, interesting. Like, well, you can hear me talking, so, but it did tell me that oh, it's trying to suppress it. That's the thing. It thinks it's
Yeah.
not supposed to be hearing it.
Yeah. So if you go to share your screen again, it's a
Okay.
little click. Just when you hit share, it's a little checkbox at the bottom left corner of the. There you go.
Yep.
It's the bane of everyone's existence, whoever wants to share sound.
Thank you for that. Oh, where did my other stuff go? I think you're seeing my
Yeah,
My
seeing the
host?
back screen.
oh, there we go.
There we go.
Whew. Technical.
I know.
Thank you for that.
It's always a challenge for everybody. Okay, well, I'll do one more minute.
You can't be in a bad mood when you start your day with this. I have Google Home in my bathroom and I often dry my hair to the song.
Oh, nice. On top of the world.
Yep.
Nice. Yeah, you got to put some good music on. That's Happy was a good one to start with today for sure.
That is a good one. I'm going to Pink in November.
Oh, that'll be
Oh,
a
wow.
blast.
A friend of mine went to a couple months ago in Toronto. She said it was
Yeah.
incredible.
I just
Love
love
it.
it. So
Those
I've been
pictures
listening.
of her doing acrobatics and like it's mind blowing what she does in that concert and singing all the time.
So fierce, like, and
Yeah.
just yeah, when you think I can't possibly do that. Think of Pink. Come on.
Yeah, an athlete. She's an athlete, that's for sure.
Yeah.
Okay,
Yeah.
everybody, we're ready to go again. We had a nice break, got a coffee if you need
Awesome.
it, or a tea or whatever. Okay, we'll get back to it.
Okay, and so yeah, this slide is just intended to remind everybody that confidence is the key thing with pitching. And I would say that in my experience, a couple of things come to mind. One, almost nobody is comfortable with the numbers. So even if you're super passionate about your business, your industry, where you're going, it's normal to feel anxious and insecure around the numbers and think that, oh boy, I hope they don't ask me any numbers. Everybody's feeling that. Like the people that aren't would be less than 1%. So this is super common. And I would say there's a gender factor here too. And the gender factor is that guys don't care as much about their lack of financial literacy or the pieces that they don't know. It doesn't bother them as much. They don't know any more than women. We all know the same amount from the financial standpoint. And I have the majority of my clients in our, tech sector, they are men. So I work with more men than I do women. And I will say that there is no more knowledge there. We're equal in knowledge, but there is a difference in the I would say the confidence or the lack of confidence. Women tend to be more bothered by it. So I want everybody to know that, so that you just work on your own inner fierce, what's Beyonce have? Sasha Fierce. You just channel something to hold yourself confident as you can be in this part, knowing that I'm not going to let it get to me. Like if somebody asks you a question you don't know, I'm going to get back to you with that. If they say a metric that you don't recognize, could you let me know how you define that? And I'll go find that. These are perfectly fine answers that buy you time in the moment. Don't feel bad. I just, in general, want you to feel more confident than you did before around where your current knowledge is on the finance side of things. And then just continue to explore it and understand it. Good news is none of the math is actually difficult. It's tricky. They're each different, they're formulas, but it's not complex math. So even if you would say that you would describe yourself as someone, I'm not a math person or something like that, you can do this math. You can do this. Okay. And more to that, if you're early stage, so what is key for early on for investors? So this is not so helpful in my chosen profession, but I would say, I'm going to interrupt myself to ask
Sorry.
a question. Yeah. Questions are more important than me talking.
Briefly initially I'd also mentioned burn, cash burn.
Yeah.
And that's a question that investors typically ask. So the confusion that I usually have is when they talk burn, that what's your burn rate? Are they talking gross burn, like when it's on net, like after revenue? What are we losing?
Burn takes many things, and it'll really depend on that specific individual and what they mean. So they could be saying how much cash are you burning per month, in that they might mean how much are you using for your bank balance a month ago? Where is it today? Did it drop by $50,000? And so on average, it could mean the amount of cash you're using each month, meaning it's not necessarily revenue, because revenue is actually, you could be invoicing your customer in advance, and the revenue you're recognizing over 12 months. So if you're talking cash burn, it could be how much cash is coming in versus how much cash is going out. You're usually having a deficit of $50,000 each month. That's your burn rate. So that could be what it means. It could also, I would calculate it using essentially your revenues minus your expenses. And you could say my net burn rate. That is a metric. So it's fair to call that a metric. It's not necessarily a measure of cash, because revenue isn't necessarily a measure of customer receipts. Usually expenses are more online. So for example, actually in your business, they may not be, because you may need to order a lot of parts that are going to ship, and they're going to show up in your balance sheet. So you're not actually expensing them until you sell them. So, so I'd say if you're in an investor situation and they're just a conversation, they're meaning on average how much cash you need every month to keep your doors open.
Right. So that factors in the cash coming in through the business and then what we are spending.
Exactly. Exactly. That's a cash calculation is probably what they're meaning.
Okay. Thank you.
Okay. So, early on, you don't even need to have a lot of financial information. So the key thing that matters from a investor standpoint, what are the key things? Do your customers love your product? Do they stick around? Do you make money from the customer relationship? And is your total addressable market huge? That's what's most important. So if you're early stage creating your pitch deck and you don't have a lot of customer data yet, you don't need it. That's why organizations that so it could be that your customers aren't even necessarily paying yet, but they've been you for 2 years you've been in market and they've been using your product, and now you're going to market with a paid version, and it's a huge market. That may be enough right there to excite them. They don't need more data than that. So early on, you don't have to have a lot of financial metrics. These are the key things they're looking for. Okay. Total addressable market. Is it big? It needs to be big. And are you going to get a good chunk of that pie? So big, big, big. From there, you're building out a roadmap. So if you're thinking about, okay, we started out, customers love us, or we think they're going to love us, we're going to be able to make money here. What activities do we have to do in order to grow the revenue from the customer? So think about it in terms of a roadmap. You're headed to, I like to say San Diego. I don't know why. It just seems like a lovely destination to get to. How are you going to go from here to San Diego? You're selling the distance. On your way to San Diego, how many customers are you acquiring each year? These are the things you want to think through. This year, I'm going to sell to 10. Next year, 100. After that, 1,000. Whatever your numbers are, think it through from a high level. I'm going to highlight again some key revenue metrics, your revenue growth rate. Yes, Jane.
Just a quick question on the trip to San Diego. How far out of a roadmap would investors be looking for?
5 years as far, so they're not expecting detail out 5 years. But I think on average, I'm seeing 3 to 5 years. So you definitely want to have 3 years.
Yeah.
And you want to have a monthly, the next 24 months is really mapped out. You really know when
more detail.
Yeah. But I would probably build something that goes out 5.
Yeah. Thanks.
Okay. And so
sorry, just to follow up on that question. These 24 months, the detailed plan, it's not for the pitch deck, right? Is it more like a next conversation or more detailed conversation later on?
It's a good question. So in the pitch deck itself, you may take the summary. So you may take the annual totals of, let's say, revenue, expense, the net, so EBITDA, cash on hand, headcount, those 5 kind of data points for each of the next 5 years. So at year end, each year, we have this much cash in the bank, we have this many people on payroll. Here's our total revenue, or our ARR, whichever number kind of looks better. And so that's all that would go in the pitch deck. But then when they say, well, show me your projections, like be ready from the pitch to present the projections, which will be in an Excel workbook. And you just, generally they want the whole workbook.
Okay, thank you.
Okay. And so we're talking, like I've talked about the ARR growth rates, what they're expecting to see. So big growth, big growth, a net dollar retention. You're showing how your customer revenue is going to, if you don't think your revenue is going to increase from customers year over year, really challenge yourself to think that through, and what the runway is, like how the projections that you're showing them, how far do they take you before you're out of cash? Sylvia.
Okay, so this is a question about the growth, cash flow, and within sort of the SaaS and one-time recurring. So if you're selling a product, you know, building it out, you're going to scale, and keeping cash flow in mind, one strategy might be, I'm going to charge one-time implementation fee for my SaaS product. You know, it's helping the cash flow. I'm funding the growth. However, when you're looking at the SaaS metrics, you don't want to have too much services. You want to have recurring revenue growth. So what are the specific metrics? And I guess from what you see, what would be the recommendation? Because I know, and we've been sort of playing around with it, you can do even the one-time implementation as managed services and amortize, you know, over a lifetime of the contract.
Yep.
Or, you know, there is perhaps maybe other ways.
Excellent question. So the good news is services are okay. They were, so there's trends in SaaS, and 5 years ago or more, you didn't want to have any service revenue. The investors only wanted to see subscription revenue, and service revenue would indicate, well, it takes a lot of heavy lifting to do your work. Because profitability is paramount these days, people no longer care if you have service revenue. So I say, when you have the opportunity to charge for the onboarding process, onboarding, training, maybe support, maybe warranty, whatever other fees you can get in there that a customer will accept in your industry, go for it. Some industries are crazy. Like there's a nonprofit association where you build a member data platform. They pay hundreds of thousands of dollars for onboarding fees. And some other software, you can't, the customer's not open to any money in one-time fees. So just really getting a sense of like whether your customer will be able to pay for that, like is willing to pay for it, and then separating the service work for that. So in general, I would say you have the service revenue and your service line costs. So if you have an implementation team, they're part of, it's the gross margin of the service. So service revenue minus the direct cost of that is your service margin, separate from your SaaS margin, which is just your subscription revenue and your those variable costs we talked about, which wouldn't be too much. So you're going to have like an 80-90% SaaS margin. You may have 30-20, maybe you even say our service revenue just offsets the cost of the service of implementing it. Does that answer that question?
Yeah, so I guess on the valuation side, and I'm not sure if this is for the session, but is there benefits of amortizing your implementation and treating it more like managed services? So it's still a service revenue, but it's more of a recurring service revenue. And then if you do have, I'm going to say like maintenance and additional service related fees, then you can kind of amortize it, I don't know, over whatever the duration of the contract.
Yeah, fair enough. So in general, I would say I wouldn't do it. From a valuation standpoint, having a clean recurring revenue, like SaaS revenue that has a high gross margin, is going to be where your valuation's likely based on. It'll be a multiple of that, including other service costs as part of a recurring revenue is likely not going to get you the return you're looking for, because it's going to have a different, in due diligence, especially down the road, the investor's going to hold you to attributing the costs to that, which is going to erode your gross margin, and then you're going to be in this negotiation with them. So I would generally not worry about amortizing them. Having said that, there are good old accountant rules, unfortunately. As you grow and you need a review engagement and an audit, there'll be a test that they do on the service cost to determine if they should be amortized or not. And it comes to something called standalone value. It's weird. It's inconsistently treated by accounting firms. So there's that caveat, but in general, I would say you don't want accounting dictating how you, the tail wagging the dog. So I would say it can come up, but otherwise my bias would be towards the service revenue aligning to the work in which it's done. So let's say you're doing 90 days of training, then perhaps having the revenue spread over 3 months to represent the time of the cost. Because that's another good accounting practice, is that what you're doing is you're actually matching principal on your income statement. The revenues and expenses should ideally be matching. So that's why with Payal's business, the cost of the product is going to be recognized when she sells the product. So you have the revenue and the expense matching. You want the same to be done in your service. So if the cost is incurred throughout the 12 months, then yes, spread your revenue over the 12 months. But if it's truly an onboarding, or like we make a few calls, we have an intro call and then you're good, then that work's all performed in month 1. That's the appropriate time to recognize the revenue and separately from your MRR. I do see some companies that have multiple recurring. So they'll have SaaS MRR, then they'll have service recurring revenue, because they may have ongoing revenue. Just keep them on separate revenue lines so that you're able to analyze them separately over time. And over time, the metric treatment might be different. And then you could have your total recurring revenue. Then from a highlight standpoint for investors, you're showing our annual recurring revenue may be a bigger number as a result of it. But from a metric standpoint, if you start to include it, now you're eroding your gross margin, which is going to erode your lifetime value. And I think it just will end up hurting you more than helping you. And it adds complexity.
Okay, thank you.
You're welcome. Payal.
So my question is about the runway. So when investors are asking about the runway, what I understand is they usually mean that if I give you so much money, how long is it going to last until you need again?
Yes.
But if we factor in some of the revenue that's coming in, and if we are close to profitability, then our runway may be infinite, right? Like we may not run out of money.
Absolutely.
So then the runway may not have a certain number that we only have 12 months or 24 months. And that is also okay for a startup.
So you could have 2 answers to them. You could say, well, actually with your investment, this is the last investment I'm going to need. I expect this will be able to scale. So that's a fine answer. And then you could also even be, really flex and say, but if my revenues don't grow, this runway. So if you don't factor in additional revenue growth, then you could indicate the amount of months left with the investment. So if revenues stay flat, or you could play with it and say, if my plan is delayed a quarter, or, you could provide, but I would say you're really flexing there. So it's totally fair to say.
Sorry.
Yeah.
Sorry, I didn't mean to speak over you. The reason I ask is what I'm usually trying to say, and probably I'm not doing a good job at it, is to the investors is, if you don't give me the funds, I will still grow and I have the runway. It won't be fast enough. If you give me the funds, there will be a spike. And to then accommodate that growth, I will need the additional cash. And then the runway comes into place.
Yes. And so I just flipped that around. I always love positive words. And I would say, look, you know what? We're already doing well, organic growth. We can hit our objectives with the cash that we have and the revenues that we're generating from our clients, but we can grow our revenues much faster with your investment. And we feel it will just accelerate that.
Right. And then in that case, the runway may come in, right? That if we were to take the road 5x, then this is the money we need.
That's right. That's right.
Understand. Thank you.
You're welcome. Okay. And so here, this is not numeric, but it is the piece. So when people ask me to help them do financial projections, I have done financial ones that I'm basically reverse engineering all the metrics to make something look really beautiful from a number standpoint, but it's missing all the context in the story. It's showing that we're going to hire this many people in these departments and generate this number of customers, but it doesn't have the story. It's so important to understand how you're going to acquire your customers, think it through, understand all the nuances of it. So daydream about your strategy so that you're then able to just numerate it. So once you know how what you believe is going to work, then you're able to indicate those resources that you're hiring, how many leads you expect them to get, how long it will take for them to close, all of that. So yeah, I would say just daydream about customer acquisition strategy. It's super important. And don't forget that there is a sales funnel. It's a process of lead finding out about you, nurturing them to an opportunity, and then they come, or maybe it's opportunity to lead. Everybody uses the words differently, but there's a journey there where you're warming them up to close a deal, and that takes time. So keep in mind that there is a time delay there. And so that sort of takes us through the revenue projections. We've identified your pricing, you've thought through your customer acquisition strategy, you know how many different types of customers you're going to be adding over time. So you can map that out on a spreadsheet over time. You now want to consider the expenses that got you there. So thinking about the variable costs, we've covered a lot of this will be familiar to you now that we've had the discussions we've had. So what are your costs to support the revenue? So if more users are on your product, do you have enough cloud bandwidth, that sort of thing? Do you need to have, at some point, are you going to need SOC 2 compliance? Are you going to need some like different things like that? Is there going to be an investment required? Thinking through that as you grow. Often we can start fairly cheaply, but there may be some milestones that we have to think about different costs. And when you're thinking about those different costs, I would say that, well, the next question that I'm always asked is like, how much cash do I need, or how much should I ask for? So it's a chicken egg kind of thing. When someone says, should I raise 2 million? Should I raise 1 million? Should I raise 5 million? I say, how much do you need? How much cash do you need? Like, it's up to you to figure out, well, this is the amount of revenue I hope to get. These are the costs I think it's going to take to get there. What's the difference? That's what helps to inform how much cash you're going to need. And in general, the area of investment needs to go into different departments. So if you say, well, I'm going to hire, some support for myself, and like, that's not generally an investable kind of use of funds. What investors want to spend money on is customer acquisition. So your sales and marketing plan, because at this point, you're going to acquire those customers and you're going to have a 3-to-1 LTV to CAC. So their money is going into generating wealth, generating a return, and or you're building the product out more in order to add more features. You're going to be able to get more money coming from your product. So these are the two main areas where you want to be able to show that your funds are going to go to. I would say a third, second, lower tier area, if you have already products in market and you believe that if you added a customer success team, you'd be able to grow the revenue from those customers by 20% if they had that engagement help, then that could be a good. So the key thing is you're looking for a return. How do you demonstrate that the investor's giving me money that is going to generate money? So the areas of money, you might need money for everything, right? You need money to pay your rent. You need money to pay a bookkeeper. You need money. Those are generally not the things you want to highlight. We know we have to cover these costs, but these are the areas where you want the money to be going. And you could also have loans that help with some of those other costs. But for investor money, these are the key areas. Okay. On your
sorry, Susan.
Yes,
Oh.
yeah, please interrupt. Yeah. Oopsie.
How about team to support those sales and marketing and research and development? Like the way I have it, for example, structured in my slide is team, sales and marketing, and R&D expenses. even though like team is really to support sales and marketing and R&D. So do you suggest maybe just having like sales and marketing and R&D and just remove that team part so that is
yeah, so you're saying, should it be structured as the money's coming in to build the team and the
yeah.
team? That's okay. That's okay. Because the number one spend, well, certainly on the R&D side, it usually translates to resources, right? You're building up your R&D team. That's where the money's going to go. The sales and marketing, it may be a little different. It's probably a combination. So in order to build up the sales team, chances are they need something. They need leads coming in. So there's marketing that needs to pair with it, or they need to be traveling to trade shows. So it tends to be a bit more of a grouping of costs, not just individuals.
Exactly.
Yeah.
Okay. Thank you.
Okay. And so on the grouping, now that we're talking about grouping, these are the general groups you want to have. So you don't want, if in your income statement, you want to evolve it to the point where you're separating out your costs, especially your resource costs. So if you have 20 employees, you don't just want one single salary line. You want to be allocating the salaries for R&D into the R&D department, sales and marketing and the sales and marketing, G&A with people that aren't there, maybe yourself, maybe if you have a support. Customer success is going to be factored into your gross margin, but starting it out, you essentially want to consider whether they're grouped and where they're located if you've got people that you've hired full-time as customer success. Then you also want to have your grants. So these IRAP or whatever grants you're able to get from the government, that would be grouped together. Interest and depreciation, you group those together because you're going to separate them for calculating EBITDA purposes. So you essentially want to group expenses into these departments. Even if they're not departments, if you're small enough that you wouldn't call them departments, it's a grouping. It's beginnings of departments. And so getting your expenses organized, first of all, I did talk about the organization by department. You want to have all your bookkeeping up to date. So that just shows that you've got good financial hygiene. QuickBooks Online, super cheap. Get everything into there. Easy peasy. And as I mentioned, allocating your payroll into those departments as well. Not just your receipts that come in, but making sure that your payroll, if you're using a payroll service, you can assign a person to a department for the payroll service. And when they issue you the report of your payroll expenses, they'll give you those line items. So it's an easy journal entry to put into your software. If you're using QuickBooks Online, you can be allocating a person as you onboard a person. You tag the department that they're in. So then when you process payroll, it automatically allocates it by department. Okay. And for your revenue, so this is again for if an investor's looking for your data room. Yes, Sophia?
Sorry,
Oh,
one more question.
Great.
For payroll, we, for example, have an animal nutritionist, and she, in theory, would support only R&D, but she also does a lot of marketing and sales, just because she's the expert in the nutrition area. So would we split that into the two categories, or just for clarity, just leave it in R&D?
Yeah, so for simplicity, I generally tell people not to allocate, and you would keep her in R&D. Okay. One, because maybe that increases the odds that you claim more of her if you were doing a shred claim, that sort of thing. Mm-hmm. The other is it just keeps your CAC low until you have a more dedicated person. So this is an evolution for me. We used to do allocations. I just think for most businesses, it's expensive because it's adding a complexity. If you have a basic bookkeeper today, they probably are not allocating. And so now you're going to be paying for more of their time to do those allocations. And I don't think you're going to get a good return on it. So I would say if somebody is doing R&D and something else, keep them in R&D. And until somebody is doing customer success full-time, don't allocate anything to customer success. And so if you have a person that does a little sales, does a little customer success, runs errands, sometimes does
That's
website.
me.
Okay, G&A, that person goes in
Yeah.
G&A. So they're not in any of those other departments.
Okay, thank you.
There's really no metric for G&A. The only thing I'd say about there is you want to keep the spend under 20% in G&A. So you don't want to have a big fat G&A. It's like, what's going on? And this doesn't look very efficient. But if your total G&A costs are 20% or less of your total spend, totally reasonable. Okay. And so getting your revenues organized, if you've been in market for a while, you want to have up to 3 years of revenue by customer. Okay. Revenue by customer. That's why it's really important that you're not just, you don't have a bookkeeper who's just putting all your sales into your accounting software in one journal entry. You really want to track revenue by customer. Ideally, you want to track it by product too. So if you have multiple products that you sell to your customers, you want to track that as well, because that will become useful information for your own analysis, but investors will be interested as well. And separating, I said revenue in the first one, but making sure that you're identifying, like highlighting the MRR. So if they're paying a set fee that covers a product and a service at the same time, you want to make sure that you're tracking those amounts separately, because they are used in the metrics differently. So up to 3 years of revenue by customer. So if you don't have that today, start tracking it today. So in 3 years, you've got 3 years it never goes away. It's always a need. And if you're building a company that's going to grow to $100 million, you are probably going to be raising money more than once. So start that hygiene now. Yes, Yisho.
Yeah, just to the point that you made, because we're also just planning on charging just a subscription fee to the healthcare hospitals.
Yep.
And that's a $500 fee, for example, per month. The hardware cost is baked into it. It's not a separate cost as per se. So do we on our end segment that out to reflect that the hardware cost, the monthly recurring revenue for the hardware is, for example, we're charging a certain amount, or should we just treat it as a SaaS product?
Okay, so I need that again. They're grouped together currently?
So we're selling the product and the subscription to the platform as just one subscription.
Yeah. Yeah, you're going to have to start breaking that out for a few reasons. As you grow and you need higher level accounting. So when you raise $1 million, you're probably going to have to move to a review engagement. When you raise above that, you're probably going to need to move to an audit. That's your year-end statements when a public accountant provides you with your financial. You give them all the information, they produce financial reports, and they test a lot of the information. There's different treatment for revenue for product and service. So you're going to need to break that down at some point for them. And if you're having it all together, your gross margin is obviously going to be lower because you have to factor in your product. And so all of these metrics are going to be, you're going to be off from the benchmark of the SaaS company. Now you're already going to have your own interesting elements to your business because you have product line as well as the service line. So you're not exactly like every other SaaS company, but I think the message you want to be able to demonstrate is that my SaaS side is runs at benchmark, and then my product line is benchmarked for product. And then the two make up my great business. Whereas
Right.
you don't want to dilute them. Yeah.
So just having that segmentation on our side and understanding what it is that we're charging for the product and just knowing it so that we can separate the two calculations.
Yes, exactly. And whether that's obvious to the customer or not, it will be an interesting, like that kind of depends on, I would say, like in general, we don't want accounting to be dictating how you run your business. You want your customer experience and all of that to dictate how you sell. But I think that you have to take both of those into consideration, whether the customer actually sees the price split out or they see one thing. Chances are they want to see it split out too. So here's the product that we're paying for, here's the service subscription, especially if they buy the one product and then what happens in year 2? Does
The
it,
product, yeah, the product needs to be replaced in year 2. So it's a 1-year contract, and then at
Yep.
the year 2 that they'll need to get a new product.
a new product? So the hardware component of it doesn't work in the second year?
We just need to replace the sensors. It could be the same headset. It's just the sensors need to be
Okay.
Yeah.
Okay. Yeah, interesting. You got some interesting components to think through there. Whatever makes the most money in the way that the customer is willing to pay. That's always my lead with that, and then we figure out the accounting for it on the back end.
We're still benchmarking our pricing. We're not set in stone. We just thought this would probably be a good pathway forward, but we're still exploring. And after what you said in terms of maximizing your revenue, and if needed, be charging a one-time fee, maybe exploring that model perhaps would make more sense for us. So just revisiting the financials.
Well, and so I have this a company comes to mind that had a product, and the product will last about 5 years in market. And so then they had a subscription that went with it, and they sold it as a bundle. And so year 1, customers covering both costs. Year 2, the price stays the same. So they're actually making quite a bit more money in year 2. But what that company ran into was that now the customers were comparing their price to comparable solutions in the market, and they now were priced high. So in that second year, when they're like, "Oh, your subscription rate's so high," so it's one. Oh, are we at the end? No, I don't know. I'm getting some kind of binky thing.
Yeah. We are at 2:00. This workshop has gone by so quickly and so many good questions.
Oh. Okay, so I still had the income. I want to add 2 little tips. Can I add 2 more tips? Okay.
Yes, absolutely.
Income statement. The key thing you want to know about is it's performative. So income statement is actually a journey. It has a start and an end to it. So the revenue is per period of time. Always, it's a performative statement. Whereas the balance sheet is actually a snapshot. It's a photo of a date in time, one day in time. As of that specific date, this is how much cash I have, how much money people owe me, how much money I owe. Those are the 2 key things that people just somehow don't know about, that I thought would be a good tip for you to know. Okay. And I don't want to go over, but we'll get these slides to you, right, Katie? And
yes, absolutely.
we'll put in there for you too. But we covered the majority of it, and I'm glad I went in the order that I did, because we got through the metrics for the most part.
Yeah. And there were so many good questions. So that's just indicating that there was a lot of learning going on. So we appreciate your time so much, Susan. And this was just always fabulous. But yeah, I think just the engagement alone indicates you were absolutely on track, and that this was really helpful for all of our founders. Also, I will be in touch really shortly. So Susan's been paired with a few of the founders, but I'll be in touch really shortly as well. She's graciously offered to do open office hours. So that allows our founders to pop in and chat with her to have their pressing questions answered in real time, which is just an incredible thing to do. So I will get that information to everyone shortly, and I wish everyone a happy afternoon. I think everybody's in the afternoon now, not morning. And Susan, if there's anything else you'd like to add?
Thank you so much. You guys were really fun. I really appreciate the questions. And I'm excited for you. I'm here to cheer you on.
Yay.
Thanks. And that was a terrific session. It was really great.
Absolutely.
Thank you so much.
Appreciate
Thank you.
Okay.
Good
Bye
afternoon.
all.
Thank you. Thank you.